I'm especially proud and privileged to be here, to be part of this incredible energy that's in the room today. And I'm hoping that through our participation as APSA, we can continue to contribute to this very, very important topic. In preparation for this summit, I reflected on what shared value means for a bank operating in Africa, which is a continent that's considered to be the second fastest growing region in the world, but also one that possesses the highest income inequalities globally. And at APSA, I think we do appreciate that our success as a bank is intertwined with the successful development of African economies and the local economies in which we operate. Our growth strategy integrates elements of shared value by making shared value central to our corporate strategy, as you would have heard yesterday, hopefully from Wendy. But we've also evolved our thinking to move away from being a passive, good corporate citizen to being an active force for good in society. And for APSA, playing a shaping role in society will result in a meaningful contribution to turning Africa's potential into possibility. And I say this statement because I think for far too long, we've been the continent that is rising. And at some point, we need to be the continent that has actually risen. And the way we believe we can achieve this is in a couple of ways. I think one of the previous speakers talked about trust as an important component. We also have to shape society through the social work we do in the communities in which we operate, but also contributing to growth and development through our own financing activities in the markets in which we operate. But we also have to drive thought leadership. And I really must commend the previous speaker on her incredible passion and journey that she's been driving from a thought leadership point of view. Because sometimes it can be quite skeptical or narrow-minded when one thinks about the work that organizations in the private sector do. So for instance, in Washington last year, we launched something called the African Financial Markets Index. Now, we launched this in response to a very specific problem. If you look at most African economies, the macro and fiscal policies that these economies run actually work against the development of financing opportunities in those countries. And for many instances, those policies are put in place with good intention, and we know that the road to ruin is paved with good intention. But the real challenge is that if our countries and our governments do not open up their markets to foreign investment in a way that allows investors to operate transparently, to operate easily, to have rule of law, certainty of security, and many other such attributes, we are going to struggle as a continent to attract investment. So we launched this index in Washington last year at the IMF World Bank meetings. And what we did was we ranked, I think, about 20 or so African countries through different categories around markets openness, the development of legislation, the rule of law, et cetera, et cetera. And when we published it, we were quite worried initially about the reaction from various countries in which we operate, because clearly if you are number 20 on the list, you're probably not very happy about that. But what's been really exciting has been the response from regulators and policymakers across the continent. They've actually invited us in to come and do workshops with them and help them think about the changes that they need to put in place in terms of the policies and laws and regulations that govern finance in those countries to actually stimulate investment and growth. So, we're driving that as our way of trying to think about the problems differently. We're also looking at how we can promote intergenerational sustainability. I saw yesterday on Bloomberg, a gentleman was talking, and forgive me, I didn't catch his name, but I did see the tagline, which says that today 55% of Africa's human capital remains untapped. Now, we all talk about the fact that our people are our greatest asset. I don't think as a continent we can leave 55% of that asset fallow. So we really have to think very hard about that, particularly given that we're going to be the continent with the youngest working age in population terms by 2034. So this brings me to how do we think about funding growth to unlock opportunities and accelerate further economic growth? We think of shared value in our approach to the way we deliver solutions for our clients. And we're quite fortunate as a bank in that we deal with, or we have access rather, to a wide array of stakeholders, customers, and so on. And we do this by thinking about customers in the context of their ecosystem. So what we've done is we've shifted away from thinking about financing clients in a very narrow silo, which is us and a specific client trying to do a specific transaction. But rather, how do we think about the customer across their entire ecosystem? And the reason why this is important is that you might be a large corporate looking to raise financing in any given area or industry in which you operate. But actually, your business is only sustainable because of the supply chain that sits around it. And the real challenge in Africa is actually the financing of that supply chain, in which sits numerous small and medium-sized enterprises. So what we've done is we've gone as far as aligning our sectors as a bank across our various client segments, so from the corporate and investment bank right through to retail and business banking, which gives us an element of scale as you think about the ecosystem. But it also ensures that we can organize ourselves better to deliver to the needs of our clients within their specific ecosystem. And let's look at a couple of examples. In the retail space, we've focused on the entire value chains for global and large local corporates within the supply chain arena, supporting small farmers, for instance, to access the supply chain of multinational commodity traders. We know that in Africa, small-scale farming is one of the biggest detriments that we have to actually industrialized agriculture. But if we don't have financing that is targeted at small-scale farmers that allows them to grow, harnessing the know-how of the larger corporates in terms of farming techniques and so on, we're going to just keep having the same problem. So what we've done is we've really worked with a number of these agricultural and commodity traders to develop small-scale farming in their own ecosystem. If you look at infrastructure, we participate, and our customers do as well, in the renewable energy programs. And we engage, again, clients across this entire ecosystem so that we not only increase access to electricity users, but we also are a key player in delivering clean energy to the continent. And even more importantly, we support the creation of local content, contributing to job creation in markets in which we operate. In addition, though, through this activity, we actually look to reduce the cost of electricity for the community. So, for instance, in Uganda, we funded a hydroelectric dam called Bujagali. We were able, through that financing, to significantly reduce the unit cost of electricity for the grid. This clearly has had a positive knock-on effect for businesses and homes. We're now in the process actually of refinancing that project finance transaction, and we're anticipating to further reduce the unit cost of electricity. But how does this ecosystem-based approach drive shared value, you may ask? Well, I think that by solutioning for our customers' ecosystems, we take a view of risk at a global or large local corporate level rather than at the level of the SME, which is often the most difficult risk for a bank to digest. Don't get me wrong, we still apply the same rigor in terms of how we assess risk. But what we're able to do in the way we operate is that we're also able to leverage the strength of the balance sheet of the large corporate to structure financing solutions across the entire value chain that actually benefits those SMEs. And by taking this approach, we're also able to provide funding based on an integrated risk view across the entire system, rather than on a single component or a single player. And this has the beneficial impact of overall reducing the risk premium that we would ordinarily attach to a transaction of this nature. We also invest in capabilities to facilitate and execute transactions seamlessly, whether you think of, for instance, in the import and export financing arena, foreign exchange risk management, which for many of you, you'll know, is a huge frictional situation for a number of corporates operating on this continent. The volatility of African currencies makes financial planning for a number of companies exceptionally difficult. and also trying to create more access to capital markets that raises more funding for investment in infrastructure to enable trade, for instance, ports, roads, and telecommunications. But we're also expanding our thinking to solve for the infrastructure gap across the continent. But we're thinking of it not just as ourselves as a key player, but also by leveraging our own ecosystem to access funding for infrastructure at an acceptable cost. We're taking a Pan-African lens also by focusing on indigenous African conglomerates. I think you'll see in the booklet that's on our tables there, it talks about the fact that the alignment of Africa's future has to be up to Africans. And we take that quite seriously. So what we did was, we did quite a bit of research a few years ago. I think we identified nearly 300 what we call African conglomerates across the continent. And these are companies that are large in their local home markets, but looking to expand into countries that are contiguous to them. And we've deliberately targeted our financing effort at these companies. Because these are, in my opinion, and I know it's the opinion of many of my colleagues as well, these are the companies that will drive Africa's growth. We obviously welcome the involvement of multinationals in the growth story as well. But I don't think anyone understands Africa better than Africans. And many of these companies are owned, managed by indigenous Africans. And they operate in industries as diverse as maize milling, steel rolling, cement, as well as fast-moving consumer goods. But is it all happening at the right pace? I think we'll all agree that it's not. And we still have quite a lot more work to do. But we do believe that it's a viable option that we have to pursue. We are encouraged by the willingness and support from our shareholders to embrace this approach. And our shareholders absolutely understand that for us as an institution to achieve our growth, we need to be part of a solution that powers African economies. For ABSA, shared value means leveraging our balance sheet and those of our financing partners, be it governments, DFIs, institutional investors, African diaspora, wealth funds, to come up with solutions that will ensure that Africa turns its potential into possibility at a much reduced risk premium. For instance, we've recently been able to combine relatively cost-effective financing from a Chinese DFI with our own deep local footprint in the countries in which we operate to drive specific financing opportunities targeted at SMEs. Under this program, we've been advanced a $700 million facility, which we are to use specifically to finance SMEs. And we are right now looking to see how we can explore an upsizing of this facility given the take-up. However, shared value must also include financial skills development. So for instance, we are a member of the African Internship Program. This is a program developed under the auspices of the World Economic Forum to improve public sector skills when it comes to infrastructure development. You might be asking why. Well, one of the big challenges that we see and which was highlighted by WEF is that infrastructure projects take way too long to move from concept through to reality on this continent. And one of the key causes of that is actually the level of skills in the public sector required to assess the bankability and viability of these projects. For those of you who work in the financial sector, there's no shortage of project ideas that come up. But the real challenge is, how do you determine whether this project is bankable or viable, and how do you prioritize better to allow us to run faster? So through this program, banks and other institutions will provide internship opportunities for public sector employees to spend time in our various organizations, working alongside our teams, so that they can learn how to better assess projects and thereby improve the public sector's ability to prioritize. This, we believe, will in turn improve the speed to market by reducing the time spent on projects that are not viable. And given the huge infrastructure backlog that we have on the continent, I think we need to run much, much faster. So in conclusion, we understand that organizations of our size and stature have an obligation to operate beyond simple financing, but as an enabler and a catalyst for growth. which in turn will benefit both society and our own organizations. In short, we want to do good whilst doing good. Thank you very much.